Hi friends, good day. Today let us try to understand about what is book value, what are the uses of book value, interpretation of book value and market value. Why do you need to know about book value through this video? According to Robert Arnott, in investing, what is comfortable is rarely profitable. Before we go in, what is book value? Book value refers to the total amount a company would be worth if it liquidates its assets and pay back all the liabilities. Book value can also be referred as the net asset value of the company calculated as total assets minus intangible assets such as patents and goodwills and liabilities. It is a company's equity value as reported in its financial statement. It reflects the total value of the company's assets that shareholders of the company would receive if the company were to be liquidated. It can also represent the value of a particular asset on the company's balance sheet after taking accumulated depreciation into account. Book value is typically given per share, determined by dividing all shareholder equity by the number of common stock shares that are still outstanding. Book value is equal to total assets minus intangible assets minus liabilities. Book value is also known as net book value and in the UK as net asset value. What are the uses of book value? Book value tells us the total value of the company's assets the shareholders would receive if the company were liquidated. When compared to the company's market value, book value can indicate whether a stock is under or overpriced. Since a company's book value represents the shareholders' worth, comparing book value with market value of the shares can serve as an effective valuation technique when trying to decide whether shares are fairly priced. Companies with a lot of heavy tangible assets like machinery, railroads, or a lot of financial instruments like banks tend to have large book values, whereas fashion designers, video game companies, or trading firms may have little or no book value as they are only as good as people who work there. If not be very useful in the later case, but for companies with solid and tangible assets, it is often number one figure for the investors. For example, when an investor is looking at the stock of a company that designs and sells apps, as it is technology company, the major portion of the company's value is in the ideas, right to create, and the apps it markets. So as it does not have tangible assets, it will show lower book value. Book value is considered very important for the investors using value investing strategy as it enables them to find bargain deals on stocks, especially if the company is suspected to be undervalued and have the potential to grow and the stock is going to rise in price. Value investing is the investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Stocks that are traded below book value are often considered a steal as they are anticipated to turn around and trade higher. Investors who are able to grab the stocks while costs are low in relation to the company's book value are considered to be in ideal position to make a substantial profit and be in a good trading position down the road. How the book value and the market value are interpreted. When the market value is greater than the book value, it means the company market is assigning a higher value to the company due to the earnings power of the company's assets. Consistently, the profitable companies typically have market value greater than the book value because investors have confidence in the company's abilities to generate revenue growth and earnings growth. When the book value equals market value, it means that the market see no reason to believe the company's assets are better or worse than what is stated on the balance sheet. When the market value of a company is less than its book value, it may mean that the investors have lost confidence in the company. In simple terms, it means that the market may not believe that the company is worth the value on its books or that there are enough future earnings. Book value is a widely used financial metric for determining the company's value and whether its stock price is over and underappreciated. However, the investors need to keep a close eye on the nature of the company and the other assets that may not be well represented in the book value. Comparing the book value to the market value of a company can also help investors determine whether the stock is overvalued or undervalued given its assets, liabilities, and its ability to generate income.
Well, thank you so much for watching. Please like this video and do share.